Jambo, welcome again to another session of Kurgateri Finance and Accountancy Tutorials. Today, I'm going to show you how to open the accounts, what to debit, what to credit, and which accounts have got what kind of balances, either debit or credit balances. So in this case, there is an approach in accounting that is known as the modern approach of debit of credits. So the modern you can say the modern rules of debit and credit. The modern rules of debits and credit. So, but before we move on, if you're new to the channel, consider subscribing. You hit that notification bell so that whenever I upload a new video, you'll be able to get it as soon as possible. So again, make sure you've done a comment on the comment section. If you have a question, feel free to reach me again via the contact details that I have provided at the beginning of this video. So without much ado, let's move straight to the modern rules of debits and credits. So there is one term here that's very common to most of you, but it is a term that is going to help you so much in determining what to debit, what to credit, and which accounts have got what kind of balances as far as debits and credits are concerned. And the term is dealer. The dealer. Dealer. A dealer. So D stands for drawings. We have E stands for expenses. We have A stands for assets. L stands for liabilities. We have E stands for equity. And we have R stands for revenue. Right? So I'm going to draw an imaginary line here, a dotted line, this way. So I've separated this term dealer into two. We have this upper side and this other side. These items here, the drawings, expenses, and assets, have got debit balance. I want you to take note. The drawings, expenses, and assets have got debit balances. Are we together? But the items here below the imaginary line, the liabilities, equity, and revenue, have got credit balances. Are we together? I want you to take keen note of here. Make sure you have understood this one. The drawings, expenses, and assets have debit balances. In short, these items here on top of this imaginary line have got debit balances. The items below this imaginary line have got credit balances. Are we together? I'll show you practically, we'll do it and you'll understand it. And you will enjoy this topic. So, increasing any of these elements here, since they have debit balances, increasing them, you increase on the debit. So increase, if you want to increase any of these elements here, or these items here, you do it on the debit side of the account. Remember, they have debit balances. If you want to increase drawings, you increase on the debit side. Right together. Expenses have got debit balances. If you increase expenses, you do it on the debit side. Or rather, you enter the transaction on the debit side. If you want to increase an asset, assets have got debit balances. If you want to increase, you increase on the credit, on the debit side. Are you together? That is very, very, very important. And then if you want to decrease any item here, you do it on the credit side of the account. If you want to decrease drawings, you decrease, but since if you want to decrease drawings, and you know drawings have got debit balances, if you want to decrease it, you decrease on the credit side. Expenses have got debit balances. If you want to decrease expenses, you decrease on the credit side. Assets have got debit balances. If you want to decrease the assets, you do it on the credit side. Are you together? Very, very, very important. So let's move to liabilities, equity, and revenue. If you want to increase a liability, remember liabilities have got credit balances. Are we together? If you want to increase the, or rather a liability which have got credit balance, you do it on the credit side of the account. So in short, you're increasing the credit side where the credit balance is. And if you want to decrease, you do it on the debit side of the account. Are we together? So I've said liabilities have got credit balances. If you want to increase a liability, you increase it by entering the same or the transaction on the credit side. The equity or the capital, this is the same as capital. If you want to increase capital or equity, which has, and it has the credit balance. If you want to increase it, you increase on the credit side. If you want to decrease, you decrease on the debit side. The same case applies to revenue. Revenue, the other name of revenue is income. All incomes have got credit balances. If you want to increase incomes, you increase on the credit side. And if you want to decrease incomes, you decrease on the debit side. This will sound like rocket science, but when we will be doing an example, a practical example, an illustration, you will get to understand it very well. So let us go straight to an illustration so that you get to understand better. So I have an illustration here. Swan Limited paid salaries Kenya shillings 100,000 in cash. Number second illustration, Swan Limited purchased goods on credit from Thomas worth 50,000 shillings. And then illustration number 3, purchased a motor vehicle worth 100,000 shillings by check. Swan Limited paid salaries Kenya shillings 100,000. So it's also important, before we handle these illustrations, let me tell you this. Before you start any illustration or any question involving such kind of where you're supposed to open accounts, it's very, very important for you to, first of all, analyze the illustration. So the first thing to do is analysis. You analyze the illustration. You're analyzing to do what? To at least get, come up with 2 accounts. Are you together? Accounts, such kind of, an account is T-shaped. You get 2 accounts. Remember the concept of double entry. Double entry. For every debit entry, there must be a corresponding credit entry. Are you together? I told you debit is on the left hand side, credit is on the right hand side. So you at least come up with 2 accounts. The one account will take the debit, the other one will take the credit. The one account will take the credit, the other one will take the debit, depending on how the transaction will tell us. So it's very important to come out to the accounts. So let's go to the first illustration. Swan Limited paid salaries Kenya shillings 100 in cash. So Swan Limited is paying salaries, isn't it? So let us analyze. We are paying salaries. So we must have salaries account, isn't it? So come here and say salaries account. And then what next? Salaries of 100,000 shillings in cash. So you are paying in form of cash, very important. So you say cash account, that is it. Are we together? Is that simple? So we've analyzed and we've come up with two accounts. Here, salaries are nominal accounts, isn't it? Cash, these are real accounts. So cash is an asset, isn't it? Cash is an asset in an organization. An asset, as per our word here, dealer, an asset have got debit balance. Cash is an asset, isn't it? Cash have got debit balances, these ones. Are we together? Salary is an expense. Expenses have got debit balances. So these are expenses, isn't it? Expenses. And these are an asset. So from what we had explained here, expenses have got debit balances. Assets have got debit balances. Are we together? So that is what I'm expecting from what we've done here. But let's go to a question. Swan Limited paid salaries. So in this question, we'll be able to determine if there is an increase or a decrease in these debit balances, since they have debit balances, isn't it? So Swan Limited paid salaries in Kenya shillings 1,000 in cash. So what is happening to our cash? We are paying salaries. The Swan Limited is paying salaries in cash. So the cash is reducing, isn't it? So we are reducing what? Cash. Because you are paying salaries worth 100,000. So the cash, remember, cash have got debit balance, and we are decreasing it by 100,000 because you are paying salaries. So decreasing an asset, that is cash, we are going to decrease it on the credit side because it has a debit balance, isn't it? This cash has got debit balance here. Let's say we have 1 million shillings cash, but we are reducing this 1 million by 100,000. So reducing the same, we are going to reduce on the credit side. Are we together? So in the name of what? We are paying salaries. Very important. Right? So the cash account is going to reduce on the credit side by 100,000 because you are paying what? Salaries. So here you write the term salaries, because the salaries and cash, that is where the double entry will come to. And remember the concept of double entry. For every credit entry in one account, that must be followed by a corresponding debit entry in another account. So the moment you've entered it, or the moment you've identified which part is going to take what, so the other account is automatic, it will take the opposite. Are we together? So since the credit side, the cash, you've entered salaries on the credit side, the salaries on the other hand, we say cash account. Are we together? So what am I trying to explain? I'm saying that a double entry concept rule of account states that for every credit entry, that is what we've done in cash account, in one account, it must be followed by a corresponding debit entry in another account. That is what I have done. Are we together? Good. So let's move on to our second illustration. I want to believe you'll understand it better. Swan Limited purchased goods on credit from Thomas worth 50,000 Kenya shillings. So Swan Limited purchased goods, isn't it? Purchased goods. So in business language or in accounting, the purchased goods are known as purchases. They're known as purchases. So we have purchase account. We've analyzed and found out that there is purchase account. And then on credit, remember when I was introducing financial accounting, I told you that the transactions are divided into two: the credit transactions and cash transaction. The first illustration is cash transaction, isn't it? But in this case, it's a credit transaction. So we have purchases account, and we have purchase goods on credit from Thomas. So we have Thomas account here. Are we together? So we will not have the issue of cash or bank because this is credit. Are we together? So it is the goods account or the purchase account and the Thomas account. So you come here and comfortably open this account, purchases account. You draw the account, and then Thomas account. So since Thomas is selling goods on credit to Swan, that means that Thomas is a creditor, isn't it? And a creditor is a liability, isn't it? A creditor is a liability on the organization. And okay, liabilities have got credit balances. Liabilities have got credit balances. And increasing these liabilities, you increase on the credit side. Decreasing, you decrease on the debit side, isn't it? So what is happening here? Swan Limited purchase goods on credit. So let us determine if Thomas account is going to be decreased or decreased. So on credit from Thomas, worth 50,000 Kenya shillings. So remember, Thomas account is a liability account and has credit balance. So Thomas account here. So an account of Thomas has got credit balance. Since we are increasing, isn't it? We are increasing. The creditor's account is increasing because we are taking other goods on credit. That means we are inflating the creditor's account, isn't it? So we are going to increase this account of Thomas by a figure of 50,000 shillings in the name of purchases. So you come here and say purchases of 50,000. And the double entry rule of accounting, I told you, states that for every credit entry in one account, there must be a corresponding debit entry in another account. So in this case, you're going to say the purchase account 50,000 is increasing. You are purchasing, that means the goods are increasing on the debit side. 50,000 in the name of who? Thomas account. So you can see how simple it is. So let's move to our third illustration, so that by the end of this third illustration, you'll have understood, at least have some clue on how to open the accounts, right? Our third illustration reads, purchased a motor van worth 100,000 by check. So we are supposed to analyze these illustrations so that you come up with two accounts. So you are purchasing a motor vehicle, a motor van account, and by check. A check is a bank account. So take note, don't say that since these purchases, you are purchasing a motor vehicle. No, you're not supposed to open the purchase account, because a motor vehicle are not goods, isn't it? So a motor vehicle will take its own account. It's not like goods. You cannot say goods account. It looks awkward. So in accounting, you say purchase account. But when you are purchasing an item, like a motor van account, that is when we are engaging ourselves in capital expenditure, purchasing a capital item, like the motor van, we say, or rather we open an account of that capital item on its own. Like for this case, you say the motor van account, and check. You cannot write check account. No, you say bank account, isn't it? A motor vehicle is an asset in an organization. It helps in generating revenue in long run, isn't it? A bank account is an asset also. And these assets have got debit balances, as per our dealer thing here. The assets have got debit balances, right? Increasing the assets, you increase on the debit side. Decreasing, you decrease on the credit side. So which account is being increased and which one is being decreased in this case? Purchased a motor van. So that means, motor vans have got debit balances. Bank have got debit balances. Increasing this motor van, you increase on the debit side, isn't it? So we are purchasing a motor van, meaning that we are increasing the motor van account, isn't it? So you say bank account, because there is a corresponding entry, double entry you'll take, bank account worth 100,000. That means this other account will take automatic the credit side. For every debit entry in one account must be followed by a credit entry in another account in the name of motor vehicle, motor van account. 100. Are we together? So that is the whole concept of accounting, how to open accounts and which ones have got debit, which one carries the credit. Are we together? So ladies and gentlemen, in our next session, we will take at least as many questions as possible on matters opening of ledger accounts and balancing them off. I'll also show you how to balance them off and transferring those balances to the trial balance. Remember, I told you when you're introducing financial accounting that the moment you've opened the ledgers, balance the ledgers, then take the balances to the trial balance so that from the trial balance you prepare the final financial statements like the profit and loss account and the balance sheet. So ladies and gentlemen, that marks the end of our session today. Until next time, it's goodbye for now.